If you look closely at financial markets, the sheer volume of data is blinding. Prices shift every fraction of a second, driven by high-frequency trading algorithms and rapid reactions to breaking news. Beneath that exhausting surface noise lies a search for structural order and long-term macroeconomic trends. In the late 19th century, Charles Dow realized that trying to interpret individual stock movements was futile. He needed a way to measure the genuine economic health of the country as a whole. On July 3, 1884, he published the first stock market average. It consisted of just 11 closing prices. 9 of these were railroad companies, which he recognized were the arteries of the American economy, offering the clearest indication of broad industrial movement. By 1897, the American economy was expanding rapidly. To better reflect this dual nature of production and distribution, Dow split his original concept into 2 distinct indices, a 12-stock industrial index and a 20-stock rail index. What grew from these early indices is now known as Dow Theory. It is important to state clearly that this is not a predictive trading system. It is a rigid, 6-part structural framework designed to diagnose the current reality of the market. Dow constructed these indices to act purely as barometers. Their purpose was to convert the chaotic, unpredictable daily price fluctuations into a clean atmospheric pressure reading for the broader economy. The theory rests on 6 core tenets. The first establishes the foundational axiom of technical analysis. The averages discount everything. This means the market reflects every possible knowable factor that affects overall supply and demand. The collective buying and selling immediately absorbs all global knowledge, fear, and even unpredictable events like earthquakes, instantly assimilating their effects into the price action. Dow relied exclusively on closing prices to measure this assimilation. He considered intraday penetrations to be invalid noise, lacking the significance of the final settled value at the end of the trading session. Because the market acts as an omniscient discounting mechanism, technical analysts do not need to parse elaborate domestic and foreign economic news. They only need to analyze the resulting geometry of the price action itself. To analyze that geometry, Tenet 2 dictates that the market operates in 3 distinct, overlapping trends. Dow compared these market movements to the physical sea. The primary trend represents the ocean tide, a macroeconomic momentum lasting years. Within that tide are the secondary or intermediate trends. These are counter-trend corrections that last weeks to months, frequently retracing between 1/3 and 2/3 of the primary move. Finally, the minor trends are the daily ripples. These near-term fluctuations last less than 3 weeks, which Dow considered largely unimportant for broad timing purposes. Tenet 3 maps the human element onto these trends. It states that major primary trends unfold in 3 distinct psychological phases. The first is the accumulation phase. This occurs near a bear market bottom when macroeconomic news is at its most pessimistic. Here, astute, informed investors recognize that the bad news is already reflected in the price, and they begin buying. Once prices begin to advance rapidly and business news improves, the public participation phase begins. This is where most technical trend followers recognize the shift and enter the market. Finally comes the distribution phase. Newspapers print increasingly bullish stories, speculative volume peaks, and the original informed investors begin quietly selling their holdings to late-arriving members of the public. If this 3-phase structure sounds familiar, it directly prefigured the foundational concepts of Elliott wave theory, which later expanded on these exact sequences. While daily movement remains chaotic, Dow's model suggests that the long-term geometry is a reflection of recurrent cycles in human psychology, moving from informed accumulation to broad public distribution. Tenet 4 introduces the system's strict requirement for evidence. The averages must confirm each other. Dow reasoned that a manufacturing boom indicated by the industrial average is an illusion unless goods are actually being moved to market, which must be reflected in the transport average. This chart shows the Dow theory at work. It tracks both the Dow Industrials and the Dow Transports over a long-term bull trend, showing how closely the 2 indices track together. The protocol man puts that a breakout to a new high in one average is not a valid macroeconomic signal. The inception or continuation of a primary bull market requires the second average to exceed its own previous secondary peak to confirm the move. When the two averages diverge, when one hits a new high but the other fails to confirm, the prior trend is assumed to still be maintained. This divergence filters out false breakouts. Tenet 5 adds a secondary layer of evidence: volume. Trading volume should expand in the direction of the primary trend, increasing as prices rise in a bull market and diminish during counter-trend pullbacks. Requiring dual-sector corroboration and volume confirmation acts as a brutal filtering mechanism. It protects analysts from acting on isolated market signals by demanding undeniable systemic proof. This brings us to Tenet 6. A trend is assumed to be in effect until it gives definite signals that it has reversed. Dow related market movement to the physical law of inertia. An object in motion tends to continue in motion until external force changes its direction. The most difficult task for any analyst is distinguishing between a normal secondary correction and the actual first leg of a new opposing trend. To solve this, Dow theorists rely on a precise geometric reversal pattern known as the failure swing. This diagram illustrates a failure swing at a market top. We can see the clear, alternating sequence of geometric peaks and troughs. The mechanical sequence works like this. The rally at peak C fails to overcome the prior high at peak A. The price then declines, violating the previous structural support established at low B. This definitive breakdown generates a clear-cut sell signal at point S. Contrast this with the weaker non-failure swing pattern on the right. Here, peak C exceeds peak A before falling below the support at B. Because it sets a higher high, strict Dow theorists require a lower high to form at point E before recognizing a valid sell signal at S2. By waiting for definitive structural support levels to break on a closing basis, Dow theory relies entirely on objective market geometry. It removes subjective emotional forecasting from the equation. Over the decades, Dow theory has faced a recurring criticism from professional traders. It frequently fails to catch actual market tops and bottoms. The mathematics behind the criticism are accurate. Because of the strict cross-confirmation rules and the necessity of waiting for established support levels to break, Dow theory misses the first 20 to 25% of a major move before generating a definitive buy signal. Mapped onto a full market cycle, you see massive missed opportunity. Day traders view the system as too slow, but critics misunderstand its core architecture. Dow never intended to anticipate trends. The strategy captures the undeniable middle portion of market moves, once structurally confirmed. While Dow created the indices purely as barometers for business conditions, the financial landscape has evolved. Today, market participants can trade the averages directly through futures contracts and ETFs like the Diamonds Trust. Despite a century of computational advancements and algorithmic trading, the standard definitions of a trend, the three-phase cycle, and the strict principles of divergence all derive directly from Charles Dow's original editorials. Dow theory remains vital because it does not attempt to serve as a predictive crystal ball. It is an uncompromising framework built on physical laws, a mechanism designed strictly to diagnose the verifiable weight of evidence in the present market.